Hello, ladies and gentlemen. Welcome to Triple N Media. I am NIK NIKAM. In this presentation, we are going to look at some technical indicators that will help us to enter a stock position. And this is geared especially for beginners to get an introduction to using technical indicators. Here is a chart of the Nasdaq main index, which is the QQQ, which is an ETF looking at the Nasdaq Composite Index. So here I have a timeline of, I think it is 10 days. Okay, that's a 10 days timeline. Let's go back to a whole month. As you can see, the Nasdaq peaked somewhere on February 16th. From then onwards, it had a continuous downtrend. It came here and it made some correction, and finally it bottomed down here. And now we have a new wave which has formed here. So let us go back to 10 days here. We have to learn certain technical indicators that will help us to identify if the stock is oversold or overbought. You want to buy a stock that has been oversold, so there is a potential for the stock to go up. For example, you want to buy something like down here, but you just can't use one parameter to decide which point to enter into the market. So we're going to look at a few parameters. The first thing, of course, I would be interested, if you're an individual investor, would be to look at the trend lines. You can look at the trend lines here, and this is actually a real-time chart, and we can change anything we want here. And this was last 2 days, February 26th and March 1st. This is a QQQ. After reaching the bottom, as you can see, this is the slow stochastic. There are various oscillators, as they are called, which we can use to see if the market has been oversold. Like here, if the market has been overbought. Once we look at these things, it will help us to see if it's a good entry point. Certainly, you don't want to enter here at this point, because the next thing you know, after a couple of minutes, your stock is going to take a nosedive, and that's what happened to me today, and I'm going to explain as what happened. But we need to have some stomach to bear whatever is going on. Keeping that in mind, let us go back to like a 5-day chart here. This is 30 minutes, so we'll just go to here. You can change timings also. It's hard to say which time is the best one to enter into the market. I think first we need to look at the main trend. The main trend here was going down, and the main trend has been broken. So now we have a trend which is trying to go in the upward direction. That's the main thing. Thinking this is going in the upward direction, now we want to focus in this area and see what is the best point of entry. So let us focus on 5 days here, and let's look at 5-minute intervals. Once you fine tune as to the point you would like to enter, you go to a 5-minute or 15-minute interval, depending on your investment strategy. If you're trying to just get in and out of these stocks like several times a day, then you may have to go to like a smaller time frame. But anything less than 5 minutes will not be quite useful, because the trade doesn't change that quickly unless the stock is dropping like a rock. As we can see, the trend was coming down from all the way here, down, 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 and this looked like a nice entry point because of several reasons. Number one, it had come down quite significantly. Number two, it is these are Bollinger Bands, which I think they track like 2.5% on either side. And as you can see, it's been bracing the bottom part of the Bollinger Bands, and it has pierced a couple of times. The slow stochastic is at like here, oversold position. It is almost zero, and this is why I set it to 0 to 100. Usually they set it to like 80 to 20, but I just set it so that here, this may be a point to enter. If you enter this point, you have some potential to gain something, and then it came down, it made some correction, and it went up. Sometimes when this goes up, you may be tempted to take some profit, which is fine. Otherwise, you have to have stomach to bear this correction. and generally the corrections can be anywhere from 38 to 62%. So this is almost like it corrected half, 50%. We should be able to have stomach to bear, and if we have that patience, then it reaches the peak here, which will be much higher than what it reached here. How does this wave help you here? Yes, because it hasn't reached the like 95 to 100 points in terms of the stochastic, showing that it is overbought. So that's one reason where you can try to push and see if you can get something out of that. And once it reaches the peak, that is, this is a good point anywhere here to sell and make some profits. So we are looking at 5-minute intervals, but if we go to 15-minute intervals, it may look different. So here's our 15-minute interval. It looks like it is going up, and this is the zigzag we saw, and then it went up. But looking at this, you feel like, well, there is still potential for this one to go all the way to 100, but obviously it just took another down to the south and went down below where the price you started. So it makes a difference as what time frame you use to make your entry and exit points. If you are doing short-term trading, for example, this is from 12 to 2, like 2 hours. If you're doing short-term trading, you may have like 2 or 3 opportunities in a day. The market is open for 6.5 hours. So you may have 2 or 3 opportunities during a day to make these small gains and profits. And on the other hand, if you want to be like the hedge fund managers, you can probably short sell the stock here or the ETF, and when it comes down, you can buy it. Or you can buy puts, which will go up in price as the stock price goes down. When you are at a terminal phase of a trend, you are going to see these fluctuations, which are called corrections based on Elliott waves. I have done a video on Elliott waves. You can take a look at that. And these are all like corrections. And this is actually the point where it really takes a positive deflection in the other direction. So let's go and study this part here. Let's go back to like 10 days and see. And 10 days, as you can see, this stochastic hits the bottom, it comes up and it comes down again. The general concept is you don't buy at the first peak of the stochastic, generally speaking. But here the first peak of the stochastic was followed by a sudden downward drop. Whereas here you saw the first peak here, then the next day the market opened and then it just continued. And generally they say it is the second peak where you really think about taking your profits and closing the stock. So let us go to a 5-day chart here. See, this is actually 26th and this is March 1st. And I will show you what happened on March 2nd, that is today. And I also should tell you what I did and what has transpired. February 26th, it went up and it stayed up. And then here the market went up and it was just hugging the 100% overbought line for most of the day. It is not uncommon for the line to brace the 95 to 100 for hours, days and weeks. So it's impossible to say when it's going to take a turn. And similarly, we saw here it was zigzagging and it was all the way up here. It didn't reach, this is 97 and this was like 90. Yeah, these are like 97%. So you have to look at these things. This one, you also have to look at the way the stock is moving, and the Bollinger Bands will help you. There are also what are known as parabolic indicators. There's another one called parabolic. Here you can see a whole host of, I would just select like 3 or 4, and these are little dots that also give you an indication as what's happening. And as you can see, as the dots touch the line, and you see the downward drift continues. Similarly, when the dots touch the line here, then it continues to go up, and this will continue to go up until this is touched by the line. Just Google some of these terminologies, pick up 3 or 4 items and try to become extremely familiar with this. Like for example, this stochastic, which is the same thing as another one called relative strength index. RSI just tracks just like this. There's another one called MACD. Just look up all these things by Googling, or just Google technical analysis of a stock market. So you bring in like several different parameters. Even the candlestick appearance, I did a video on candlestick, you can look at those. You bring all those things and try to make an intelligent judgment. So let us look at the market here, and this is what it dropped here, and then it took off, and this is where it was. This is the first 5 minutes, first 30 minutes. Let's go to maybe 5 minutes here. Okay, let's leave it here because I just wanted to get an idea as what's happening. Okay, this is what happened yesterday with Nasdaq. I'd rather go to 15 minutes here. Let's go to 15 minutes, and this is what happened to Nasdaq here. As you can see, it was bracing the 90 overbought line and just dipped down a little bit, and it continued. If you are a follower of Elliott waves, then you know you have an impulsive wave, then you have a correction, then you get a second impulsive wave, and knowing this, I expected a second corrective wave in the market today. So that was my anticipation when I started at 8:30 in the morning. This is just before the market opened, and let's move. This is a good way to learn, like computer practicing of your entry points and exit points. Now, before I go further, I want you to make a decision as to what do you want to do. This is overbought situation here. Do you want to enter the market here, or do you want to just sit and wait, or do you want to wait till the slow stochastics reaches the bottom and make a reasonable judgment? And as you can see, this is at the upper rim of the Bollinger Bands, and this is not helping us very much at this point. At this point, I decided, okay, I think even though the stock opened higher, I had a suspicion this stock was going to drop. And sure enough, as I expected, the stock dropped in the first hour. So I'm just going to show you the first hour. Okay, and this is where the stock dropped continuously. And looking at this trend line, I expected the stock to kind of level off around 319. Actually, I don't trade QQQ. I trade TQQQ, which is 3 times the triple Q, because I said if I'm going to take a risk, I might as well take the worst possible risk. So this is TQQ. This is the first 15 minutes. Okay. This first 15 minutes, as I expected, the stock continued to drop. Let us look at what happened in the first hour. Stock continued to drop here, and based on this line, I expected the stock to sort of level off around $94. All right. And it came to $94 and it bounced back to $94.92. I bought the stock at $94.20. Let's continue. See, because it had reached the bottom, I decided to buy it because this one was at the bottom and it was reaching the support line at 93.5. So I decided to buy it at 94.20. And this was helping me, this was helping me, this was helping me. So I figured, I should be on the right track. Okay, let's see what happens in the next couple of hours. Here's what happened. I bought it at $90.20. I could have gotten off here. Then they continued to drop below like 93.20. Then I had a second chance to get out at 95, and for 1,000 shares, I would have made like $1,000 profit. But I just continued to stay there because I know the whole part is a correction to this big move that we had, which was like $10 in the TQQQ price yesterday. So it continued, and this one is somewhere in the middle, so you don't know which way it's going, but it has broken the trend line. Let's continue here, and it continued to go up above the trend line. I could have actually bought any place here, that would have been fine, but I just wanted to wait, and because I waited, the market closed at 92.30, so almost lost $2,000. But I'm not worried about it, because based on these technical analysis, to me this is a normal correction pattern following a big move. Stock just doesn't go in a continuous fashion. It is going to be correcting here. After that, hopefully next day it will come up. In fact, I had another account where I bought the stock for like 92.50. So I think I will make up some loss there. Now it has hit the bottom. Let's go to, this is 15-minute interval, by the way. So this is where it is, and I will try to show you after hour trade here. Let me show you the after hour trade. Okay, here is the after hour trade. It is trading around this trading like 92.55, something like that, and we just follow this. My guess is, and here's the first wave we had. Here's the correction based on Elliott waves. Like this is 1, this is 2, this is 3, and of course I had to take out, let me take out the after hours, because we don't count the after hours. So this is 1, 2, 3, A, B, C. The reason I am not concerned is because this followed the typical A, B, C pattern. And just like here, A, B, C, C. The B is always bigger than the other two waves. The B has multiple waves. So this is A, B, C, and this is third wave of the big cycle, and this is A, B, C here. So hopefully this will come back up, but I am optimistic because 1, it pierced through the Bollinger Bands. Number 2, the stochastic at 15-minute interval is at the 6.21, which just says it is kind of oversold. So hoping that it will come back and I can recover this one. More importantly, I am looking at a longer term picture here. As you can see, when you shrink this a little more, and here was the major trend that was coming down. Now we have a change in the direction, and we lay 1, 2, 3, 4, and the 5 will probably come all the way up to here, maybe tomorrow, up to 96, 98, because it already opened at 98. And it's probably going to go beyond that. That is my assumption based on technical analysis. So this is the first introduction to technical analysis of how to use technical indicators to enter a market. And the technical indicators that you use to enter the market will be the same for technical indicators to get out of the stock market, except you mirror image the same principles. So let me summarize what I have been talking about. Number 1, we use the trend lines. Then we can use these Bollinger Bands and parabolics. Of course, you have to learn when all these dots make a difference, because the slant of the dots makes a big difference. And how quickly the dots are rising also makes a difference. And when the dots hit a particular line, the new dots start from the other side. And then that may indicate a change in the direction of the stock prices. Then you also use some kind of an oscillator here. Let me show. This is the slow stochastic oscillator. Let me see if we can change that to RS, relative strength index. Okay. As you can see, relative strength index sort of parallels these waves, and it may give you a different indication. And one more point I would like to show is when we are looking at the slow stochastic, you have to wait till the yellow line, I mean it's just a yellow line I'm saying, has to cross this red line. So your red line is this is the 14-point average, and this is the 3-point average. So the longer average has to cross the shorter average. That's when you enter the market. So those are some of the points that will help you. And there's one more I would like to show you here before I conclude indicators, that is MACD. MACD is another indication which is showing a different way. It also has the waveforms like the stochastic, but if it is going down like this and you look at this one is coming up, that means this one, and it's kind of flat here. And when this is going up, these mounts, each one of these tell you that you are climbing. And when there is a plateau, that's an indication there is a sign of overbought situation, and it is going to be followed by a decline as we saw here. And let's look at here. This is what happened. Oversold situation. It came here, but the significance was not that significant. That's why a combination of these waves will help you. So I would suggest you learn different parameters and do this electronic trading like this. For example, let's say you are here and this is a new day. The stock opens with a gap and it drops here, and where would you enter the market? Would you enter the market here and write down what do you think you expect to see? Is it going to go up? Is it going to just go down? Or is it going to stay flat? Then move it for half a day and see what happened to the stock and what happened to the technical indicators. Then your decision has to match with what actually happened in the market. If it happened, that's great. Then you just follow it for another time. Okay, then you say, well, I think I'm going to take some profit here, because look at this one is up, this one is up, and this is the Bollinger Bands are being pierced. Okay, let me take some profit. Next day you come back here, the stock opens low and goes lower and still hasn't hit the bottom, but you have to decide. You can use a smaller time frame if you want to make a short duration sale. Let's go to 5 minutes here. If you decide you want to enter the market here, see if this can help, because where is this? Where were we? Yes, like here, because this is the 15 minutes not going to help. So see if you are just trying to make a short term market. It was here. So it had come down. Where's that gap we saw? Anyway, so if you come to the 5 minute intervals, again, you see it can brace the baselines or the top lines for hours or days. When it reaches a zero, then you probably, maybe a good point, this is where I would probably get in. But again, you have to understand this is the end of the day, so you have to be careful, because it may go up and then it may end up with a 50% correction. Okay, let me stop at this point, and maybe next time I will talk about how to exit a market based on the same principles. And please do subscribe to our channel. We'll see you next time. Thank you so much.